Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of Your Fiscal Physical podcast. My name is Aaron, and I'm joined by Ryan Nelson, founder of Alchemy Wealth Management. You can find his popular book on Amazon. Please check it out. Like I said, I think it should be taught in schools and be required reading, but that's just me, myself. Ryan, how you doing today?
Doing well. How about yourself?
Can't complain, and I am even more excited, or I'm doing even better, because we got a question from one of our listeners here.
Oh, that's what I like to hear.
And we are very excited because the lovely Eric emailed in with a question, and keep in mind, you can also email in at email us at podcast@alchemywealth.com. Eric was awesome with this. He actually sent in an audio clip with his question, so which I think is the preferred format. Wouldn't you agree as far as like sending that in?
Absolutely. I'm excited to hear it.
Yeah, so we'll go ahead and play this clip for the listeners. Eric's got great diction, so he's going to detail his question, and then Ryan will go ahead and break this down. So give it a listen.
Hello, this is Eric, and I had a question regarding asset allocation. I did a little research and found that investing in a passive fund that tracks the U.S. stock market may be an effective and easy way to start investing. However, these funds do not contain any bond allocation. As a new investor, my question is, what is the benefit of investing in bonds? And if bonds are a benefit to any portfolio, what percentage of my investment should be towards bonds versus stocks?
Thank you, Eric, for that question here, and a lot to break down in that overall, Ryan. So I'm very curious to see your thoughts and just to kind of give a high-level overview of how to best address that.
Yeah, it's a fantastic question, so thanks for submitting it, Eric. And really, I love how it compounds on the last few episodes we've done, and the question is that of an asset allocation question. And, if I understand Eric's question correctly, he's really asking, should he be investing in something like the S&P 500, index fund that tracks the S&P 500, and just leave out the bonds? Does he need any bond exposure? He's a fairly aggressive investor, it sounds like. If so, what would be the benefit of adding those bonds? And so it's a fantastic question, and a question I get fairly frequently. And I'd like to maybe start addressing the question with an analogy, and it's a story. I can't validate the accuracy, the validity of this story. So let's treat it just as a story. I don't know how factually accurate it is to history, but as the legend goes, when the Titanic first launched, it was not known for being the biggest ship, which is what I perceived. It was actually known for being the fastest ship. And so supposedly, again, as legend goes, it was the fastest ship. And so they load this thing up, they get all the people, all their luggage on the ship, they're about to make their journey, and the engineers realize, like, with this much weight, so apparently they were going to make this particular trip, they were going to do the route faster than any ship had ever done that route. And so the engineers kind of were crunching their numbers, and they said, well, we're heavier than we thought we were going to be with all these people, all this luggage. We're not going to make the time that we basically said we were going to make. And so then one of the engineers said, well, the boat's unsinkable, isn't it? And they said, yeah. And they said, well, why do we have all these lifeboats on it?
Ooh.
Why don't we strip out these lifeboats? We'll drop the weight and we'll be able to make the time. So they say, yeah, that's a great idea. So they strip out the lifeboats, right? And so then they make the journey. We all know how this story ends. Unfortunately, the Titanic hits an iceberg. Apparently, it's not an unsinkable boat, and the Titanic sinks. And so, how this analogy applies to finance is we can kind of think of stocks being more aggressive, bonds being a little bit more conservative. So if we were invested in all stock, right? We're a little bit more aggressive. That's kind of like the speed. Bonds are sort of going to be like our lifeboats, right? And so if we were in 100% stock, we would be a more aggressive portfolio, and we would get from point A to point B theoretically faster. Bonds, though, are these lifeboats, and you don't know when you're going to need that lifeboat, right?
Sure.
But if the market was to crash, we alluded to this in the previous episode on asset allocation. The correlation between stocks and bonds is low, and so oftentimes if stocks fall, there's lots of scenarios in past history where bonds actually go up and help subsidize some of those losses from your stocks. And so, the question becomes, in this example, the Titanic, they forfeited their bonds, so to speak, for maximum speed. In hindsight, it's really easy to look back on that and say, well, that was a little irresponsible. We probably should have diversified our portfolio, put the bonds or the lifeboats on, slowed down our overall progress, right? Slowed ourselves down, and long term, maybe the Titanic would still be sailing the seas, right? And so it's a argument in risk mitigation. You don't want necessarily to take all the risk you can just because the expected returns are theoretically higher. So hopefully that, again, I don't know how true any of that is about the actual Titanic, but hopefully it's a decent example to illustrate the point in the value of bonds. Even though the expected returns of bonds are lower than that of stocks, we don't just want necessarily to always put all our money in stocks just because they're higher expected returns.
No, that's a great analogy, and I can't remember seeing that in the movie with Leonardo DiCaprio when they were talking about that, but I'm sure that it probably came up that they're like, hey, we don't have enough lifeboats. And they're like, it's unsinkable.
Yeah.
Like, why would we need it? Like, as far as that goes. And next thing you know, Leo's falling off a door and dying. So, but being able to break that down in that way of, kind of equating like, cool, speed and almost like safety in a way.
Yeah.
But having that balance specifically, and once again, it kind of ties back into our previous episodes of, what goes into asset allocation, what's your risk tolerance, what is your, risk capacity, just in general too. So I like that kind of all comes full circle.
Yeah, 100%. And I want to read this quote from Warren Buffett that I think applies to this. So Warren Buffett once said, "The first rule of investment is don't lose money, and the second rule of investment is don't forget the first rule." And that's all the rules there are. So again, the first rule of investment is don't lose. The second rule of investment is don't forget rule 1. And that's all the rules. That's Warren Buffett. And it's funny because most people consider him the greatest investor of all time. Most people probably think about him in regards to the incredible returns he's gotten.
Right.
But one of his founding principles is risk mitigation.
Mm-hmm.
And that's being able to stay in the game for so long is how you can get those such amazing returns. It's actually taking advantage of kind of some rules of compounding, which we can address in a future episode. But it's less about any probably one individual year's returns and more so about getting those returns year after year after year. And so let's put some numbers around this risk mitigation concept I've talked about a couple of times. So let's think about a hypothetical investment, because it's easy to just say, oh yeah, risk mitigation. What's that mean? Like why?
Right.
Why, okay, you're saying it's important. Why is it important? And so this is just a mathematical concept that I think is foreign to most of us. I was an engineer, and it still was a little foreign to me until I actually kind of saw the numbers and like thought about it a little more. And so let's just take a hypothetical $100 investment.
Easy math.
Yep.
Love easy math around here.
So you have a $100 investment. Let's say you lose 1%. $100 goes to $99. To get back to even, it's pretty easy. You basically get like 1%. 1% of $99 is 0.99%. So you're up to 99.99%. So you lose 1%, you get 1% back. You're basically back to even, right? If you lose 10%, your $100 investment turns into $90. Now you need an 11% return to get back to even. So you lose 10%, you need 11% to get back to even. So you can see there's an asymmetry between the loss and the return. You actually need bigger returns to get back to even. Now let's look at some bigger examples. So if you lose 25%, you have a $100 investment, it drops to $75. Do you know what returns we would need to get back to even?
More than 25%.
Yeah, absolutely. Yeah. So if we have $75, if we're down to $75, we need to get $25 to get back to even. So that'd be a 33% return. Oh. So
that's a lot different than just pretty much a 1%. Like when you started out, that's now 8% more than you actually lost.
Right. Yeah, exactly. So we lose 25%. We need 33% returns to get back to even. You can start seeing that asymmetry grow. So we lose 1%, we basically needed 1% to get back. We lose 10%, we need 11%. A little bit more. Now we lose 25%, we need 36% to get back to even. That's kind of substantial, right? Yeah. If we lose 50%, so our $100 investment turns into $50, now to get back to even, we need $50 more. We need to double our money.
100% more.
Yeah. So you need 100% return to double your money. So you lose 50%. You need to wait to get 100% returns, double your money till you're back to even. So you could see in that example, like if you could have mitigated some of those risks and if there was a really bad year, instead of taking a 50% hit, if you could have only taken a 25% hit, instead of needing 100% returns, you would have only needed 35% returns to get back to even. It's a lot easier to get 35% returns than it is 100% returns, right?
Absolutely.
So there's that asymmetry. We can go look at a couple examples of even more extreme. If you were to lose something that's ridiculous, like 90% losses, your $100 investment would drop to $10. You now need to make $90 back. So you need to make 9x, right? Your investment, right?
Yeah, that'd be a little. That's quite daunting.
Yeah,
when you put it like that.
That could take decades. To get back. So, so if you take too much risk, and in any one year you have a huge loss, it could take decades to recover from. A lot of people, back in the early 2000s, there was what we call the tech bubble. Some people were invested like 75%, 80%, 90%, 100% of their net worth in technology stocks. It hit a bubble. When that bubble burst, a lot of people lost huge percentages of their net worth. There's stories of people losing like 90% of their net worth. When those people, to get 9x your money back, that takes decades and decades to return it. So going back to Warren Buffett's quote, the first rule of investment is don't lose money. The second rule of investment is don't forget the first rule, and that's all the rules there are. You need an element, if you want to maximize your returns, you need an element of risk mitigation. So yeah, I don't know if you'd thought about those numbers at all in the past.
I hadn't until I actually saw them when we were outlining this podcast and looking at them and being like, wow, like that makes so much sense when you put it. When you just talk about the numbers in general, you're like, okay, cool. Like, if I do lose 25%, I need this much. All right. And it just continues to grow and get bigger and bigger. So you're talking about the 90%. Cool. Now you need 900% to get back to even. And just painting it like that, it makes you think that, hey, you probably should have some risk mitigation in there, right, without a doubt. Like, unless, once again, everyone's personal decision on how they want to handle it, but just be prepared for the potential consequences with that.
Yep. And so going back now, applying this to Eric's question, I think he asks directly, should he own any bonds? And, again, we're not giving financial advice here, so I don't know if he should or if he shouldn't. But the benefit of bonds is they provide that risk mitigation. They are, they provide risk mitigation two ways. Diversification, right? So sometimes bonds zig when stocks zag. That's one way. Also, they're just a more, in general, a less risky asset class than stocks. So what is the value of bonds? Bonds can be, when used correctly with a stock portfolio, they can be used as a bit of a risk mitigation tool. So I think a logical next question would be, well, how much bonds do I own? Should I be 90% bonds then? Like, now I'm scared. Now I'm scared. I don't want to lose everything.
Right, yeah.
Do I need
a lifeboat.
Yeah. Do I need extra lifeboats? Yeah. And, I think if we keep using this Titanic analogy, the reality is, like, you don't need more lifeboats than there are people on the boat.
Right.
Sure. That would probably be too much risk mitigation. Should you have a lifeboat for everybody on the boat? I would say probably. I don't want to be the one on that boat that doesn't get a lifeboat, right? So if you go back, we mentioned this a little bit. I think it was last episode where we talked about the rule of 110 in regards to asset allocation. So again, it's a rule of thumb. I don't really like using rule of thumbs, but it's good for demonstrations purposes. And so if you had a 30-year-old individual, we applied the rule of 110. 110 minus 30. That's going to leave us with 80. That'd be 80% stock, 20% bonds. It helps give you kind of an idea. The younger you are, you can have a lot of stock in a few lifeboats, only 20% lifeboats, right? If we apply the rule of 110 to an 80-year-old, 110 minus 80, that's 30% stock, 70% bonds. That person's going to have a lot more lifeboats. The primary reason being is their time horizon is shorter. They don't have time as a benefit anymore. So if there was a market decline, they wouldn't have as much time to let that market just naturally come back up. So they want to mitigate more risk, right? So when you're trying to figure out how much, if you buy into the theory, like, okay, I don't want to just invest in like an S&P 500 fund. I do see some value of this risk mitigation and using bonds to help mitigate risks. How much should I have in bonds? That's a unique, personalized decision. Mm-hmm. But the younger you are, probably the more aggressive you can be, have less lifeboats, less bonds. The more, the older you are, more conservative you are, more lifeboats, more bonds.
Right. And it all depends on, once again, you hit on it there for sure, is your goals. Are your goals as far as like what you want to do and how fast you want to get there, and are you, that risk capacity of the individual themselves.
Yep, exactly right. So it'd go back to the goals-based investing. So figuring out what your goals are, figuring out your risk capacity, your risk tolerance, partnering those together to determine how much risk you should be taking. And so, I always think about this as trying to help people reach their goals with as much certainty as possible, right? So the more risk you take, yes, the expected returns might be higher, but are you increasing the likelihood of hitting your goals? So for example, if you think about this a different way, maybe if you were to inherit, $10 million somehow, well, if that's enough for you to live your lifestyle for the rest of your life, you sort of already made it. Should you be taking any risk? Do you need any risk? Because you could go invest it in stocks and bonds, and then what happens if the market crashes and now all of a sudden you're left with less money and not enough to live your lifestyle? So it's an individual choice, but what we want to do is figure out what your goals are, what's the least amount of risk we can take to get you to your goals, and in doing so, we have the highest certainty, right? The most likelihood of getting you to your goals. So a lot of times I'll hear people just asking about like, this investment, it's more risk, but higher expected return. Let's just go with higher expected return. I want more money, more. But when we actually think about it, it's like, well, are you, do you actually want more, or do you want the highest percentage opportunity of achieving your goal? If you want the highest percentage opportunity of achieving your goal, you'd approach this whole situation a little bit differently and actually take the least risk possible to still the least risk possible that still allows you to get to your goal, which again, for a 30-year-old might still be taking 80-90% in stock and only 10 or 20% in bonds. It could be a completely reasonable portfolio for somebody with a longer time horizon.
Yeah, definitely. And that kind of just paints a great picture overall. And one of the things that also paints a great picture is in your book, your Fiscal Physical, there's a lot of graphs I've mentioned in a couple other episodes here that are really helpful to kind of paint that picture of like, hey, cool, this is what that breakdown looks like. And a lot of times that's how I am. I'm a visual person. I like to see those different graphs and kind of see those timelines, and being able to visualize that is huge just in general. And I think it's on page 116. There's a great graph to kind of which you can kind of put into words just overall.
Yeah. So obviously, if you said it was page 116, you can also go Google the efficient frontier. And if you pull up this graph in front of you, you're going to see this curved graph that starts in the bottom left-hand corner. It kind of curves up steep, so it goes up quickly and then starts to kind of taper off and go to the right. And so, again, you can Google efficient frontier if you want to see an example of one of these frontiers. But it's a great visual, but I'll explain what it means to you just kind of in layman terms. And when you start on kind of the far left, zero risk, as you take 1 unit of risk, so you take a little bit of risk. When you're starting from no risk and you take a little bit of risk, you get quite a bit of returns. Mm-hmm. So I'm going to throw just numbers to this to hopefully make it easier to conceptualize. These numbers are pretty meaningless, so don't put any value towards these numbers, but hopefully it illustrates the point. So let's say you take 1 unit of risk. So if you take 0 unit of risk, you're going to get 0 return. Right. You take 1 unit of risk, you might get 3% return. Oh, that's not bad. I could take 3% return. Sure. You take an additional unit of risk, you're not going to get 3% more of return. You may only get 2% more return. So if you take 2 units of risk, you're getting now 5 return.
Right.
3 plus 2. If you take a third unit of risk, an additional unit of risk, a third unit of risk, you're not going to get even 2% extra return. You're only going to get, say, 1% extra return. So now you're taking 3 total units of risk, and maybe you're getting 6% total return. Then you take an additional unit of risk. So maybe now you're taking 4 units of risk. But you're not even going to get a full extra percent. Maybe you're only getting 0.5%. So you're taking 4 units of risk and you're getting 6.5% return. And each additional unit of risk you take, you get less and less added return. So you eventually get to a point where you're like, gosh, if I take an extra unit of risk, I'm only getting like 0.01% extra return, but you're still taking a full extra unit of risk. And is it worth it at that point, right? And so there's typically some trade-off there. So the curve starts to flatten off and you get to a point where, again, each added unit of risk doesn't add much added return. And so in hindsight, you probably want to take some balance there and say, okay, there becomes a point where taking extra risk, it's not worth this extra risk. This little tiny bit of extra return probably isn't worth the extra risk for me. And so, not a bad idea to Google that chart or Google that.
What was the
table.
name of the chart again? It's
the Efficient Frontier.
Efficient Frontier. Okay, gotcha.
Yep.
Yeah, definitely check it out. Or you can go ahead and buy Ryan's book and check it out there too.
Yeah,
so
there you go.
You're going to get a lot better return on your investment just by getting the book. I'm just going to say that overall. But and I think that it really one piece of this, and once again, Eric, really appreciate the question. Is something that you told me one time is that everybody needs to manage their not everybody needs a financial advisor, but everybody needs to manage their finances. So
basically,
quotes aren't my strong point.
Yeah. So what I like to say is everybody needs to manage their finances. Not everybody needs a financial advisor. And you can manage your finances yourself. That's 100% appropriate way of managing your finances. But everybody should be managing their finances. If you don't like managing your own finances, then of course you could outsource that to a financial advisor. That'd be a reasonable thing to do. But yeah, everybody's finances should be managed.
Yeah, and I think that's a great place to kind of end that segment. We'll be back on the other side of this with a palate cleanser and a trivia question. So stay tuned.
And now, to put the personal in personal finance.
All right, Ryan, we have a trivia question here. This kind of relates to, and I always like to humanize the voices behind the mics, just so people. We're talking financial advice here, and concepts and stuff. And sometimes those can get a little into the weeds and stuff too. So we'll bring it back with a little bit of a fun topic here. You're a big basketball fan.
Sure.
You and our supporter, if I'm not mistaken here.
Absolutely.
Do you still have your season tickets? I don't know if you.
I do.
Nice for the UNR basketball. So I got a question related to the University of Nevada Reno basketball.
Okay.
Who is the all-time leading
Nick
scorer?
Fizika.
Oh man. Okay. Now who is number 2?
Is it Green?
No.
Let's see.
So the question was the number 2 or overall
all-time
leading scorer for the University of Nevada Reno.
Oh God! When you say it, I got a name on the tip of my tongue. God, Rogers isn't a name.
But Nick Fizikas was number 1. You nailed that one. Yeah, that's it.
Who is it?
It is Deontay Burton.
Oh no, that was not. I would not have guessed that. That's crazy. I didn't realize he was so high up there, but
he played here he played I think 3 years, maybe 4 years here overall. So it's just longevity.
He had a great career. Yeah, definitely that stat is definitely a longevity stat, and he had a great career. That's crazy though. I wouldn't have picked him as number 2.
Yeah, I knew. I figured you'd get Nick Fizikas, so I was like, let me throw in the second one here for sure. But Nevada's got a good team this year, it seems like, overall. Like I'm excited to kind of catch a couple of games there over at Lawler for sure.
Yeah, absolutely.
But awesome. Well, once again, we really appreciate the question. This episode was specifically around listener questions, listener feedbacks, and we really want to plug that. Email us at podcast@alchemywealth.com. Send us a text, shoot us an email, however your preferred form of communication, carrier pigeon, whatever it might be. We'd love to break down some of those topics and kind of relate it to you personally.
Yeah, absolutely. Eric, thank you for submitting the question. I think it was a phenomenal question, and I think lots of people were probably thinking the same thing. So glad we were able to hopefully give some education around that. Looking forward to all your guys' future questions, and hopefully we can give more education around those as well. So as Aaron said, please reach out to us. We'd love to hear from you. And as always, stay the course.
Thank you for for joining us for the Fiscal Physical podcast. Until next time, happy listening, and as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode, and consider leaving us a rating and review on your favorite platform. This helps other listeners like you find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.